Richard, this has been the question for weeks now, if not months, since probably November of last year when we kind of saw the peaks in the NASDAQ. What would signal in your mind a possible bottoming taking hold in technology?
So I think what's happening right now with the companies is that while we see the reaction in the stock market being very rapid, the companies themselves are in the process of shifting from pursuing growth to conserving cash. So you see that in the news about hiring freezes. You see that in companies quietly pulling back from potential M&A that they might be looking at. And generally, it's going to take more time till the companies readjust their outlooks and their business models. And indeed, I think the buy side has already anticipated further cuts to earnings that the sell side typically is very slow to price in.
So if that's the case, if that dynamic is in play, are there certain places within that technology and communication services trade that are perhaps closer towards that bottoming process than others, given that kind of information gap, that kind of a little bit of movement between how certain parts of the market are viewing certain types of stocks?
Absolutely. And you're starting to see something you didn't see in the massive run-up you had last year and certainly till November, which is differentiation. Clearly, you've seen the big tech companies sell off less hard. They have the luxury of having large cash pools on their balance sheet. For example, Google has $120 billion of cash. They won't be obliged to pull back from the projects that they have ongoing. They aren't going to be obliged to have a blanket hiring freeze the way some other companies that are burning cash might. So you've seen areas like Google, Apple, Microsoft relatively outperform. You've seen companies like TSMC, which has a phenomenal franchise, go down much less than the wider market. So it's not just the big techs, but there are other places you can look at across tech that still have a pretty good secular outlook. I mean, the auto semis market is certainly not anywhere near supply-demand balance. And even with softer demand, it's going to take a long time for supply to catch up. So that route that you're referring to is not really across the board. There is a lot more differentiation right now. And that's kind of welcome to investors because it brings back this notion of adding value from stock picking.
Yeah, differentiation means opportunities, right? So Richard, if you look towards that, you mentioned a couple of names there. What would be, in your coverage universe, the most attractive at current levels, knowing that we might be even further down given today's action?
Look, we're going to see more downside in a lot of names, but we are seeing something unusual for us, and that since we're independent and therefore we've had a large number of sell notes for the last year or two, we're starting to see companies like Uber, for example, where we've pretty much been sellers or neutral since IPO. We actually put a buy on it. I think if the company doesn't generate cash by the end of the year, they're going to have some serious management challenges. You'd likely see management changes and a reconstitution of the business, and the pressure's on. I think there are other companies that we're looking at for a potential rebound, but you would probably want to see the shape of 2023 come out. For example, we have a very out of consensus view on Intel, where we're buyers. Consensus is looking for no earnings growth. They have huge upfront costs to reset the business. And we think as they start to get their house in order, that's a stock that looks right now to be at really record low valuations that might be interesting as a rebound into 2023. But I think for the near term, you're going to see numbers get cut and continued concerns about the impact of inflation on consumer spend, and that flows through to the largest sector of the market, which is tech.